Hey, Dan Passarelli here. I'm shooting this a little bit before the close here. It looks like the S&P 500 will close a little bit higher, but we're going to get to that in a minute. What I have to talk about first is specifically the VIX. For those of you who aren't familiar with the VIX is the CBOE Market Volatility Index, which the Dow Jones Company has referred to as the fear gauge, because there tends to be a bit of an inverse relationship between an option's implied volatility and the direction of its underlying. Now, the VIX measures the implied volatility of the S&P 500. So if you look at this chart of the VIX, it's a one-year chart. And I'm kind of hovering, making a little bit of a support line at where the VIX sits today. We can see that over the last 1 year period, there's only been about a 2.5 week period back in the end of November, beginning of December of last year, where VIX has been below this level. Now, it's kind of a strange thing in that a low VIX indicates complacency, but what tends to happen is that when the VIX gets to a low level, it tends to spike back up. And why does it tend to spike back up? Because that's when the market tends to go down. And so when the market is nice and relaxed, has a lot of complacency, feels like everything's going great, well, that's when the bogeys come out of the closet, as they say. They come and sneak up on you and smack you over the head. How can we trade the VIX? Well, there's a couple ways. One is with the ETF VXX, and you can even use options on VXX. But the thing with VXX is there's a natural decay feature to it. If we take a look at VIX here, and then if we look at a chart of VXX, you see that there's much more of a downward bias to it. As you can see right now, it's lower than it's ever been in the last year. And that's because of the contango nature of the futures. And I've done a video on that in the past. I can do one again in the future, but it's out of the scope of what we're talking about today. Needless to say, I don't like to buy VXX or VXX calls when VIX is low, because if it takes a while for it to end up heading back up because the market sells off, if the market doesn't sell off for a while, we can get kind of triple punished by it. Triple in that VXX doesn't go up, we get time decay on the calls, and we get the feature of the natural decline over time of the VXX itself. So if we can't buy the VXX, what can we do? Well, one thing we can do is we can wait. We can wait for periods where we get spikes like this and buy VXX puts. In fact, back here is a time when I did that, and it can really work out pretty nicely, but you have to wait and be patient. You can't just do it when you want to do it. You have to wait for these times when you get a spike like this, or like this, or like this. The next thing we can do is we can hedge investments. VXX, well, let's go back to VIX specifically. VIX is the implied volatility of 30-day options in the SPX, S&P 500. So right now, you can get insurance on your portfolio for really, really cheap. Now, the market's complacent. The market's been heading higher. We'll take a look at that in a second. It seems like, well, maybe I don't need insurance right now. But as they say, buy them when you can, not when you have to. We always have to get ahead of that and buy our insurance before the move. And another thing we can do as far as trading VIX is to speculate, to take advantage of buying puts in anything that has a correlation to the S&P 500. So now we're talking about like playing a bearish move in the S&P 500 in a complacent market, how likely is that? I mean, look, we've just been straight up since the beginning of April. I mean, just 4 months of a nosebleed rise. I mean, oh my gosh. It went from about 480, almost 480 to 640, more than 640. That's 160 points from 480. Oh my gosh. I mean, that's like 25% rise or something, just sort of doing some rounding here to the nearest quartile of a century of numbers. So we look at this and we think, is there really any cause for SPY coming down? And of course there is. From a fundamental standpoint, the PE ratio is at nosebleed levels. But from a technical standpoint, there's something else that caught my eye today. We have a divergence. We made a new high in the S&P 500 around here, and we made a new high in the RSI, the Relative Strength Index. Here, we made a higher high in SPY, but we made a lower high in RSI. This is called a divergence, where this one had a higher high tilting up, this one had a lower high tilting down. When we have a divergence in anything, we tend to default to the indicator. That's why we have indicators, because they can give us information that we can't otherwise see just looking at a chart. So this would be a bit of a bearish signal for SPY. Now I want to zoom in. I want to zoom in and go to the 6-month chart here, just so we could look a little bit closer at some things. Another thing is, as we climb, like while this was climbing, we had really high volume. We had kind of high volume here, maybe even here, but the volume's been dropping off. The market's rising, but volume's dropping off. When we see volume going down, whichever way the market is going, that can potentially be a sign for it to reverse, that the trend is slowing down. So, am I calling a big bearish move in the market here? But am I calling to be a lot more cautious? Maybe hedge long-term investments? Maybe move a little bit more to cash? The numbers all seem to indicate that that might be a great idea. Hope that helps. This is Dan Passarelli, Trade Smart.